Welcome to Academic Gain Tutorials. In this video, we will look into the differences between bad debts and doubtful debts. Goods and services are sold for the purpose of generating revenue for the business. However, all the goods are not sold in cash, and goods on credit are allowed to a number of customers. So, the customers to whom goods are sold on credit are called debtors. If out of the total sum due, a certain percentage of the sum is not recovered due to non-payment, and the amount due from debtors is called debt. Bad debt refers to the sum due from the debtors, which remains unrealized, and so they are written off in the company's books of accounts. On the other hand, doubtful debts refer to the debt, with which there is an uncertainty as to the degree to which amount will be recovered from the debtor. So, let's look into the basic differences between bad debts and doubtful debts in a tabular form. Difference number 1. Bad debt refers to the amount which a customer owes to the firm, whose likelihood of recovery is remote as it turns out as irrecoverable, whereas doubtful debt implies the amount which a customer owes to the firm, but whether they will be receivable or not, cannot be ascertained on the date of preparing the financial statement. Number 2. In case of bad debts, the debtor's account is closed by debiting the bad debt account and crediting the debtor's account, whereas, when it comes to doubtful debts, the debtor's account, whose debt is identified as doubtful, is not closed. Number 3. While bad debts represent actual loss, doubtful debts represent anticipated loss. This is due to the fact that doubtful debts have the probability of turning out as uncollectible in the future, but in the case of bad debt, they are clearly recognized as uncollectible. Number 4. As in the case of bad debt, the amount due is written off in the books of accounts, so the claim against the debtor does not exist, whereas, in the case of doubtful debts, the debtor's account is not closed, so the claim against debtors exists. Number 5. As bad debt is an actual loss to the firm, it is tax deductible in nature, whereas doubtful debt is just an anticipation of loss that may or may not occur in the future, so it is not tax deductible. Number 6. When a specific debtor defaults in the payment of the amount due from him, it amounts to bad debt, whereas, when there is uncertainty as to the recovery of the amount due from various debtors, it is termed as doubtful debts. Number 7. In accounting, the amount of bad debts is deducted from the number of sundry debtors. Further, the loss occurring due to bad debt can be charged against the profit and loss account, or the amount is adjusted against the provision made in this regard. Conversely, for doubtful debts, a provision is created, which is a charge against profit, so as to cover the loss if the doubtful debt turns out as bad debt. Number 8. In case of bad debts, as the debtor's account is already closed, so when he pays the amount either fully or partially, the amount cannot be credited to his account. Rather, the amount is credited to a bad debt recovery account or bad debt dividend account, and its balance is transferred to profit and loss account. In contrast, in the case of doubtful debts, when the amount due to the debtor is realized, the amount is credited to the debtor's account, and the provision created for the doubtful debt is treated as gain, and so it is transferred to a profit and loss account. And difference number 9. As bad debts is not a part of sundry debtors, and so it is not shown in the balance sheet of the firm. Oppositely, doubtful debts are a part of sundry debtors for the purpose of creation of the balance sheet, and provision for doubtful debts appears as a deduction from sundry debtors.